Hi, BADM 107 students. I just wanted to show you the view out the window of the room in which I'm doing my videotaping. And it might be a little hard to see, but on the lawn there are three deer. One standing and two lying down, one a little bit behind the tree, so it's kind of hard to see. But I really do live in a corner of the world which has to be defined as paradise. Now, after having shown you that, I'm going to put this on pause and then I'll begin the next portion of this chapter. And now, continuing on, I just want to mention that in Gibson's we have an occasional rabbit, an occasional raccoon, an occasional coyote. We have seen some bear here and lots of deer. Lots of deer. So it really is a lovely place to live. And I'm very fortunate. I think I've mentioned that a couple of times in some of my videos, how fortunate I am. And I do really mean that. Now we are heading into our next topic, which is forms of business organization. We are going to look at sole proprietorships and partnerships in Chapter 7, and then we are going to look at corporations in Chapter 8. And in passing, we'll mention a couple of other types of juridical persons, i.e. legal entities, which have some business applications but not directly, societies and cooperatives. On slide 158, we deal with sole proprietorships, which are unincorporated entities, owned by a single individual who has unlimited liability. Now, what's that mean? Well, all the debts and obligations of the business are not considered to be separate from his or her personal assets. So if you're running a sole proprietorship and you have a disastrous problem and you wind up owing a lot of money either through debts or tortious liabilities, the courts take no distinction between the business assets, which may be inadequate to cover the losses, and your personal assets like your house, your cottage, your cars, your sailboat, your investment properties, your Starbucks shares, and your firstborn child. No, I'm only kidding about the child. So it's a high-risk way of doing business, but it does have some advantages, and we'll get into that in a minute. But right at the bottom of slide 158, you see the Family Law Act in BC. This is a statute which says that all the assets in a family relationship, whether it's marriage or living common law, are deemed to be owned 50-50. That statute, like the Human Rights Code, can be used for a purpose slightly different than it was intended for. For example, when I graduated from law school, did my articles, passed my bar exams, I got called to the bar. What's that mean? Well, I walked across the stage in the Supreme Court House downtown Vancouver, and the Chief Justice of the Supreme Court said, which meant congratulations, Holden, you've passed the bar, although it was kind of hard to understand because he does mumble. So I got my little scroll and I was in my legal robes and I walked down off the stage and my wife came running up to me and she said, "Oh, congratulations, sweetie." She gave me a little kiss on the cheek and I grabbed her and I went, and I kissed her and I said, "Congratulations." And she said, "Why are you congratulating me?" And I said, "Because from this day forward, you own everything." Okay, so we bought cars, we bought a house, we bought a cottage down in the States, we had a sailboat. In my halcyon days, we drove a Porsche. All those assets were put in my wife's name. I'm in a high-risk profession. Lawyers, doctors, and engineers and accountants, all they do is make judgment calls. Well, you make a judgment call and you do the best you can, you're okay. But if you make a judgment call and your client loses, the client's knee-jerk reaction is to think, I lost not because I was wrong, I lost because I had a bad lawyer, and so they sue their lawyer, okay? So I transferred all the assets into my wife's name, and then I practiced law. I'm going to touch wood again. I was very fortunate over my whole career that I never wound up being liable to anyone for negligence or any other tort for that matter. So I was fortunate, but I could have been sued, and let's say I make a mistake on a file and there's a $5 million liability. I have $1 million worth of insurance. That's what you'll get. Okay. You will not get $5 million out of me. Oh, wait a minute. I've got a house. I've got a cottage. I've got a car. I've got a sailboat. I've got, some investment properties. No, I don't. I don't own anything. My wife owned it all. And when I transferred it to her at that particular point in time, the presumption is that I'm doing it for estate planning purposes, which basically I was, all right? But what that effectively does is it puts all those assets out of legal reach of my creditors should I wind up owing a lot of money. Now, if I'm working away on a file and I open it up and I go, oh my gosh, I made a mistake. Oh, hey, guess what, dear? I'm transferring all the assets to you. No, too late. But because I've done it 30 years ago and I make a mistake on the file, there can be no presumption in the court that I passed my assets to my wife to defeat a creditor of whom I was aware. All right? So I have made myself judgment proof. There's a term you should know for examination purposes, judgment proof. It means I can be sued, but you're either only going to get some limited amount from me or you're going to get nothing at all. Now, you can garnish my wages because I do have a job at Capilano University, but that's going to be ineffective. If I owe you $4 million and you get $1 million because you got $1 million in insurance, you can garnish my wages, but 30% of my monthly wages for 6 months is not going to cover the other $4 million. Why 6 months? Well, because right after being sued successfully, what I'll do is I'll declare bankruptcy because I have insufficient money to pay off my creditors. All right? So you can garnish my wages for 6 months, and then I apply to the courts to be released from bankruptcy. What that means is, oh gosh, I'm released from bankruptcy, all my debts are absolved. So you can use the Family Law Act to make yourself judgment proof, but nowadays it's getting a little more difficult, and if you ever decide to do this, what you have to do is make sure that you go to a lawyer and get good advice, all right? There's a statute called the Fraudulent Conveyances Act because I have conveyed those assets to my spouse, and that statute has to be satisfied because if I did it within 1 year of being sued or 1 year of finding out that I've made a mistake, then the presumption under that statute is that I did it to defeat a creditor and that transfer will be set aside and those assets can be attached. All right. So I guess for the clever ones in the class, you're all probably sitting there thinking, if Peter's wife owns all the assets, what happens if she decides to run off with the mailman? Well, there's two problems with that. Number one is the mailman is nowhere near as handsome as I am. Okay? Ha ha ha, that's a joke. In the reality of the situation is she could run off with the mailman, but she will not get to take all the assets. The Family Law Act deems all those assets own 50-50. So even though they're in her name legally, I have an equitable interest in them. So she could run off with the mailman, but I will be able to go to the court and get half of those assets back. Now, if I'm being sued and I get half of them back, then they go to my creditors, right? But that, as I said, did not occur. So let's look at the advantages of sole proprietorships. Simplicity. You register your name with the federal government under the Partnership Act, believe it or not, for some real strange reason, and you get a business license. Bingo, you begin operating. That's it. You have absolute personal control, fewer regulatory requirements, tax advantages, some initial tax advantages. You have to be really careful about tax advantages. I hate talking about taxes because during my whole legal career, all I ever did was I referred clients to an accountant if they had tax questions. It's another minefield. But basically, when you when you start your business, all those expenses, the business license, your lease on premises, your installing hydro and things like that, and registering your name, all those expenses are expenses of the business. and can be deducted for tax purposes. Profit. If you make a profit, you get it all. Ease of dissolution. How do you stop? You just stop. Okay, so that's pretty much it. On slide 160, we get to the disadvantages. You have this unlimited liability that I tell you about, and you may not be in a situation where you can transfer your assets to a spouse, and you certainly cannot transfer them to the children. Okay, you think, oh, I'll put the assets in my son's name. Well, your son can say, gee, thanks, Dad, and keep them, because it would be considered a gift and he would legally own them. You cannot go under the Family Law Act and say, hey, I'm deemed to own half that. No, the Family Law Act says the spouses are deemed to own half, okay? So you have this unlimited liability problem. Lack of management support. The only way that you can actually get managerial support for something that you don't know how to do well yourself. And that is by hiring them. And then you hire them, you've got the cost, and then if you want to get rid of them, you've got the problem of giving them the proper notice and things like that. Taxation. Wait a minute, didn't we say that was an advantage? Yes, when you start up a sole proprietorship, there are tax advantages. Over time in a sole proprietorship, however, it becomes a disadvantage. If you have other income from other sources, it gets added to the income you're making from your business, and you're taxed on that. When you start breaking $110,000, $120,000, you are paying a minimum of 50% of those funds to the government for taxes. Okay, taxes, not only income tax, but sales tax, GST, all those things. So eventually it becomes a disadvantage to have a proprietorship. Difficult to raise capital. Well, you've got your personal assets, which you pledge as security for loans. After that, you've got nothing. Okay, so you have this difficulty of raising capital from traditional sources. Now, if I put all my assets into my spouse's name, then gosh, I'm protected against unlimited liability, but I don't have any assets to give in support of a loan. So there's that difficulty. And then there's secession uncertainty. Now, I can end my business really easily, but if I die or if I want to retire, do I have a family member that wants to take it over? No, then who do I transfer it to? And what happens if I'm hit by a bus on my way to work one morning? Okay. The difficulty is, unless I have structured my affairs correctly, and we'll get into that in Chapter 9, but unless I've done that, who takes over my business? I have one client who is incredibly successful. He's now incorporated, but when he was running his business initially, he was a sole proprietor. And he was making money hand over fist. And I said to him one day, I said, Shane, what happens tomorrow if you passed away? And he said, what do you mean? And I said, well, what happens to your business? And he said, well, I'd want it to go to my children. And I said, yeah, but you run your business, and without you, there is no business. So unless the business continues after you're dead or after you're even incapacitated, it becomes worthless because the assets are negligible. It was the services you were providing that were important. And he went, oh, I hadn't thought about that. So you actually have to work out a secession plan, somebody that can take over and run your business if you're incapacitated or if you've passed away, so that the business can be sold as an ongoing concern when it would have more value, or it can be transferred to your children. So those are the disadvantages. All right, now we're going to look at partnerships. And right here, I have to stop and make an announcement that you should know about. In the lecture materials, on, I think it's something like page 45, and I'll confirm that. I think I've got a set of them at home. I give you sections of the BC Business Corporations Act, about 5 pages, and then I give you 2 pages of sections from the Partnership Act. These are the ones that I think it's really important for people to be aware of, okay? And for that reason, I'm giving them to you so that you can bring, well, I've got open book exams, so it really doesn't matter, but you can bring those into the exam with you, and you should be able to make reference to those. It used to be I had closed book exams and you were allowed to bring in those pages. Now you can automatically bring them in. But I want to let you know that they're there. That doesn't mean that, okay, during the exam, let's see, oh, there's a question here that might relate to a section of the Partnership Act. I'd better read those. You do not have time to do that during an examination. Okay, so we're going to touch on, as I lecture, the important sections of that statute, and then you should familiarize yourself with them so that in the exam you can go right to them and use them to answer questions if there is a question about them. All right, so right off the bat, Section 2 of the partnership defines partnerships. It defines it as the relationship which subsists between persons carrying on business in common with a view to profit. All right, so you're a sole proprietor and you can do certain parts of the operation, and then there's other parts that you just cannot do. Your 2 options are, well, 3 actually. You can struggle along, or you can hire a manager, which is very expensive, or perhaps you can find someone to become a partner in your business, and they can take over the parts of the operation that you have difficulty with, and then you can put your time towards those things that you're best at. Bingo, the second you do that, you're in partnership. And right off the bat, there are advantages and disadvantages. And I'm going to, remember how I said, up front, you should know some biases of your instructors. And one of those biases was that I'm a little negative towards partnerships. Well, here goes. Okay, so keep that in the back of your mind. On slide 162, we have the advantages. The pooling of financial and physical resources. Okay, so you want to start a gardening business, and you've got a little bit of money, and you've got some gardening tools, and your friend has a little bit of money and a lawnmower. Bingo, marriage made in heaven. The 2 of you can get together, pool your financial resources and pool your equipment, and you will have a jump start on the business. Increased borrowing power. Well, I've got assets that I can pledge to raise money. Your partner has assets that she can or he can pledge to raise capital. So you have more access to capital for expansion purposes. There's a combination of skills and knowledge. I talked about my husband and wife baker operation that owned the 2 restaurants. Well, that's exactly what that was. Chris had a phenomenal knowledge. He was of cooking and baking and running the restaurant. He was trained in Switzerland and became a master chef, and then specialized in Italian food. And his wife had business acumen. She probably couldn't cook worth a bean, okay? But she could run the operation and he could run the kitchen. Okay, so they're pooling skills and knowledge, and that is a big advantage. Disadvantages, there's quite a few on the list on page or slide 163, and take these seriously. The disadvantage of sharing profits is, okay. You have a chance of making greater profits, so perhaps you're sharing more, so you're okay. But on the assumption that you're, just getting by, then obviously sharing profits is a disadvantage over sole proprietorships. I'm going to come back to joint and several liability, big time. That's the biggest risk in partnerships. But decision-making deadlocks. I entered into a partnership, Mackay, Turlock, and Holden. None of us were, I had some business acumen. I had been in business and I had an MBA degree. But we're lawyers, and that's what we want to concentrate on. And over time, it became apparent that the business manager, our office manager, had absolutely zero managerial skills. Okay, how did she get her job? Well, she was there before I joined the firm, and her credentials amounted to the fact that she was the wife of the senior partner's best friend, and she needed a job. Okay, do not hire somebody under those conditions. You think you're doing them a favor, you're not doing yourself a favor. So there's the senior partner, Bob Mackay. There's his best friend. There's his wife. She needs a job. Hey, I'll hire her. She can be the office manager. She was terrible at HR management. It was like a revolving door. People coming, people going, people coming, people going. Remember how I said getting rid of or having to hire people can be a tremendous cost? I know that for a certain. Okay, so we had that real problem. She would... You'd build a file and you'd send a bill out to a client. And so you'd build a file and you'd have the receipts for the disbursements and you'd give it to her and she'd file it away and then she would try to collect the bills. One time I had a client call me up and he said, Peter, there's a disbursement on there and it was quite a large amount. And he said, what was that for? And I said, I'm not quite sure. I'll grab the file and I'll check. So I go and ask her what that disbursement is, and she comes back and she could not find the disbursement. No, she couldn't even find the file. Okay, and I'm going, oh, well, what do I tell the client? So if I cannot find the file and I cannot find the disbursement, I tell the client, well, I don't know what it was, but gosh, it must have been legitimate. No, I have to call the client and say, look, we're having trouble here. I cannot find that disbursement slip, so just deduct it from the amount that you send in. And that was happening a lot. Okay, so I kept saying, look, we have to get rid of her. We have to hire somebody that has the capabilities of doing it. And Bob Mackay, of course, says, oh no, I can't do that. It's the wife of my best friend. And Lance was the intellectual property person, and so he was sort of a friend of Bob's long before I came along. So anyway, finally I'd had enough. I got them into the office and I said, okay, meeting. I vote to fire her. Bob says, I cannot fire her because she's the wife of my best friend. We both look at Lance, who goes, I don't know, do whatever you want. And he ran out of the room. And I thought to myself, well, there's some bad luck. I'm in partnership with the only lawyer in the whole world that does not thrive on controversy and advocacy. Okay? He just, and suddenly we go, well, one vote for, one vote against, one abstention. What happens? Deadlock. Nothing happens. Okay? So we just muddled along. We were making money, okay, but nowhere near what we should have been making because she was costing us a fortune. Okay, time-consuming decisions. That decision happened quickly, but try in a firm like that to do some strategic planning. The three of us would get together. We'd be interrupted. Oh, Lance has got to go because a client called. Let's get together on Friday. No, I can't because I'm going to court. It was impossible for us to get together during the business week. Finally, we booked off a Friday. The three of us went to Victoria, and we took rooms in the Empress Hotel and left our cell phones at home so that we could just say, okay, what do we have to do to make this business better? And that was when a lot of the arguments about the business manager occurred. So time-consuming decisions. Personality conflicts, they can happen. We didn't have those, but they could happen. Dissolution of the partnership. This is a bit of a problem. You want to bring the partnership to an end, which we did. You have to actually send out letters to all your clients saying that the partnership is broken up. You have to file a notice in the BC Gazette, which is a business publication put out by the government that says what companies have been formed, what companies have dissolved, what partnerships have been formed, what partnerships have dissolved, and so forth. And you have to contact your suppliers. Why? Because Mackay, Turlock, and Holden. Somebody's dealing with Bob Mackay, Turlock, and Holden, Mackay, Turlock, and Holden. And we break up the partnership unless we tell that person is dealing with Mackay. Mackay makes a mistake. He's negligent. Who gets sued? Well, Mackay, Turlock, and Holden. Why? Because that person still thinks there's a partnership there. So you have to be really careful about the dissolution of a partnership, a real problem. Okay, and then you have to register your partnership in Victoria. You dissolve your partnership in Victoria, but because the public doesn't check the registry all the time, you have to do all these other things. Secession uncertainty, 3 partners, one of them passes away, what happens? Okay, we all invest $100,000, so the business is worth $300,000, and one of them passes away, woohoo! Okay, the 2 remaining people now have $150,000, right? Wrong. Why? Because the estate of the deceased partner comes and says, I want 1/3 of the value of the partnership. Now, you start the business, you yank out $100,000, that business is probably going to fail. Well, you just go to the bank and borrow money. Based on what? There's no additional value to the business. The assets that were used before are being already used. So there's no way the bank's going to give you money to solve a problem like that. So you have to take steps to manage your risk. We'll get into that later. We'll talk about partnership agreements. All right, now I want to get into the joint and several and joint liability. Joint liability. All partners are jointly liable for the debts and obligations of the business. This is your bank loan. This is any other loans you've got, any amounts payable to suppliers and that sort of thing, jointly, together. So the business owes $80,000. Well, let's make it $90,000. There's 3 of you. You each owe, $30,000. However, and that's specified in I think Section 11 of the Partnership Act. In Section 12, it says basically that you're jointly and severally liable for negligence. So there's 3 partners, three partners, and this partner is negligent and winds up owing $900,000. That's him, not us, right? All 3 of you are jointly liable, and all 3 of you are severally liable. What's that mean? Well, he winds up owing $900,000. And he goes to Brazil. Okay? The other guy goes, and he grabs the money out of the bank, and he goes to Mondovia. You're here. You can't leave. You got a wife. You got kids in school. And so you stay here. Well, fortunately, you only owe $300,000, right? No, you owe the full $900,000. So one partner is negligent, and you wind up liable for that other partner's negligence. This is an incredibly dangerous liability. Okay, so I think it's one of the reasons why, when you're starting a business, it's obviously easier to start a partnership in some respects than incorporating a company, but you might want to say, okay, from a risk management perspective, what is the likelihood of us being sued for a lot of money for some negligent activity? Now, if you are a supplier of paper products, it's sort of like packages of loose leaf paper, what's the liability there? None, okay? But if you make chainsaws, okay, somebody was negligent that made that chainsaw. So you look at the risks associated with your business, and then you decide the advantages of being a partner over the advantages of being a corporation, and you make your decision. Okay. We go then to slide 166, talk about partnership remuneration. If you're a partner, you cannot pay yourself a wage or a salary. Whoa, why would I be a partner then? Because I want to make money. No, what they do is they say, okay, you're supposed to work for a year, and then at the end of the year, you look, oh, 900 or let's see, $90,000. Three partners, you each make 30 grand a year. Okay, so you're supposed to do it that way. What you can do, obviously, because you cannot not pay your rent if you're leasing an apartment, or you cannot not pay for your car loans, or you cannot pay for your mortgage if you have to wait a year. What you do is you take a draw against future earnings. Okay, and then at the end of the year, you've taken out $40,000 each, and you only made $90,000. Ooh, you got a problem, right? You're $30,000 in the red, and you either have to put money in or get some sort of other financing to pay off the rest. The next topic is types of partnerships. Now, right, a bit of a glitch there in the power. But the next topic is types of partnerships. And there are general partnerships, limited liability partnerships, and then there's some things called joint ventures and strategic alliances, which we're not going to spend very much time on because they're just hybrids of the other three. But general partnerships is what we've been talking about so far, where you all have joint liability for debts and obligations and joint and several liability for tortious liabilities. Limited partnership is a situation where you have, and this is on slide 167, where you have three partners, let's say. You could have five partners, you could have two partners, whatever, but let's say three, and you've all invested the full amount of those money that you have or can raise, and the partnership is doing well. But now you want to take it to the next level. And so you need an infusion of capital. But you have used up all your assets, and the banks say, "No, look, we're not lending you any more money. Until your accounts receivable get better. But you cannot get those accounts receivable better until such time as you take it to the next level." So you have a bit of a catch-22 there. What you can do is, let's say there's three of us, and I sit there and I go, "My Uncle Harold, he owned a marketing and advertising advertising agency, and he sold it, and he's got this money, and he's looking for somewhere to invest it." So we go to Uncle Harold, and we say, "Okay, Uncle Harold, how about becoming a partner in our firm?" And Uncle Harold says, it looks like you got a really good opportunity to make money here, but I'm not certain that I really am all excited about being in partnership with my nephew, who I think is a bit of a nerd. Okay, so you say, okay, well, why don't you invest as a limited partner? Which means that Uncle Harold can invest $50,000 or $60,000 or whatever into the partnership. And as long as it's a limited partnership and registered as such, then he will have no liability for the debts and obligations of the business or the jointly and several liability for a tortious liability. All he has at risk is his $50,000. So if the business gets sued for $3 million, he has no liability whatsoever for that. He loses the 50 he's invested, but that's it. The requirement is that there be at least one general partner, okay, but in this case there's three. And then the requirement is that there be at least one limited partner, and that's Uncle Harold, okay. Or there could be three of us and we could get two limited partners, or they could be two of us and we could get five limited partners, whatever, okay. So it's easier to raise capital. and the liability is still on the regular partners, and the investor gets none. Now, keep in mind that you form a limited partnership using Section 50 of the Partnership Act, and then Section 64 is one of those mines in the minefield that can explode. Uncle Harold used to be in marketing and advertising, and he's now invested $50,000 in our business. So the three of us get together and we think, well, okay, this is great. All right, we've got our money, and now we got to take it to the next level. And what we need is a marketing plan. And we sit there and we look at each other, and I go, well, I do criminal law. Well, I do corporate commercial. Well, I do family law, but none of us know anything about marketing. So wait a minute, Uncle Harold, he was in marketing and advertising. He'll want to do a marketing plan for us because, if he does a good one, it's more likely that he's going to get a return on his investment. So we ask Uncle Harold, and he does that. He's no longer a limited partner. Okay, he has gotten involved in management. Section 64 of the BC Partnership Act says if you get involved in management, then you become liable as a general partner. It's a BC Partnership Act. Every province has its own Partnership Act, and Ontario is different. Okay, there, if you are a limited partner, you can actually be involved in management as long as you have no control. Okay, so you can invest, and they can hire you to do marketing and advertising for them, or you can do a marketing plan for them, but you cannot be involved in the management of the business in the sense that, okay, let's vote on the marketing plan. All those in favor? You can't do that. You cannot do that. So, and if you're involved in control, it doesn't mean you have 51%. Okay, it just means that you are making managerial decisions. So the statutes are different, but in British Columbia, you do not get involved. Well, who's going to know? Think about that in advance. The partnership gets sued for a huge amount of money, and there's three of us, and we're jointly and severally liable. I would rather have somebody with a lot of money jointly and severally liable with me because it will cut down my obligation. Okay, so my Uncle Harold, I might not say, hey, Uncle Harold, but you have no relationship with Uncle Harold, so you might say, oh, hey, this guy was involved in management, he should pay some of the money too. All right, so that's limited partnerships. Now, we're not going to say very much about limited liability partnerships because I don't think they are going to get used as much as we think outside of accounting and law firms, okay? And by that I mean all jurisdictions pass legislation creating the right to establish limited liability partnerships. So back to our three-partner example, we become limited liability partners. What does that mean? Well, we're still liable for the debts and obligations of the business. What it does mean, though, is if another partner is negligent and gets sued for a huge amount of money, he is or she is solely liable to pay that. So the three of us, hey, that's great, yeah. We're jointly and severally liable for the debts and obligations. That should be true, but why should I be liable for someone else's negligence? So that's good. In our partnership, Mackay, Turlock, and Holden, that would have worked fine until we hired an associate lawyer, which we did. Okay, and then we had two legal secretaries, and what that does is it exposes us to joint and several liability. Okay, because if the associate is liable, limited liability partnerships protect the partners. He's an associate. He screws up. We're jointly and severally liable for his negligence. One of the legal secretaries screws up. We are jointly and severally liable for those negligence, that negligence. Okay, so the larger the law firm, it provides a level of protection for one partner against another partner, but if you have a number of associates, and Russell and Dunlong, for example, was a large Vancouver law firm. I don't know whether it's in existence still or whether it's been merged with another international one, but they at one point had 98 associates. Well, you cannot dodge the liability bullet in that situation. Okay, joint ventures. Joint ventures are a legal entity like a partnership, which is established but for a project basis. Example, there's a lawyer, there's a real estate agent, and there's a property developer and a banker. Well, the four of those could get together to form a partnership to buy a lot, build a house, sell it. Okay? Then it's over. Okay, so, but do you want to go into a partnership with a lawyer? Because he might be negligent on another file and you're in partnership with him and you become joint and severally liable. No, he's got his partnership, or he's got his law firm over here. So he forms a joint venture, which is just for the development of that one piece of property. The property is sold, the money is divided up, the partnership is dissolved. This is a joint venture partnership, and it's only for a particular transaction. If the partnership is on an ongoing basis, then it will be considered a general partnership, and you do not want to be in partnership with a lawyer under circumstances like that. Just read about strategic alliances. It's a contractual arrangement more than a partnership. And sometimes it's just a loose association of businesses for, pooling some resources to do some marketing in the Far East or something, but their operations are separate. It sort of looks like a partnership, but it isn't. And so that's all we're going to say about that. Okay, I got joint ventures down there twice for some reason, but just ignore that. Risk management in partnership operations. The first thing you do is you say, okay, let's get together and form a partnership. Yeah, ho, ho. Stop and think, what's the risk here? And if there's a high-risk situation, then what you want to do is you want to consider forming a corporation. We'll get into the reasons for that later, but that can protect you. Second thing, look at the Family Law Act. I'm in a partnership. Can I transfer my assets to my spouse safely in order to perhaps defeat my creditors and make myself judgment proof? The other thing you want to do for absolutely sure, and if the partnership is on the final exam in some way, then you want to make sure that you mention it. And if it doesn't seem to fit into the problem, write it on the side of the page, because I am a firm believer that if you're going to go into a partnership, you had better have a partnership agreement. And I will explain one scenario to show you potential problems, and only because we don't have time to go through all the potential scenarios, and I'm sure that there are lots I haven't even thought about. Okay. I remember I said when we were talking about seals, I had a really good friend who had a marketing and advertising agency, and he sold it and went into a partnership with 3 other people. This is it. Initially, they went into a partnership, and 2 partners were limited partners. They invested money, and 2 partners were general partners that were going to have the liability. And the partnership was established for the purpose of running a cruise ship franchise operation, where people can go in and they can buy cruises. Before COVID-19, nobody's buying cruises right now, but before COVID-19, cruises very popular. So they'd run this partnership, and they would sell cruise ship trips for people, and they would get a commission from the cruise lines. So the two people that are going to be running it decide that, well, my friend came in and said, well, what should we do? And I said, get a partnership agreement. And specifically because it outlines things like they decided the cruise ship franchise would operate for 7 days a week. Okay, so they would be there overlapping, but one would be there for 5 days, and then the other would be there for 5 days, but it would overlap, right? So there's always a manager there. 9 to 5. But if either of them decided to use the premises and the facilities to do something with respect to cruise ships sales after hours, okay, then they would get to keep that money separate. But anything they made from 9 to 5, 7 days a week, would be pooled and divided equally between them. All right? So they say, okay, yeah, that we want to do that, and they give me instructions, and I prepared a partnership agreement, and I couriered it down to them. Well, they were very busy. Okay, they had to do FAM tours, which means they go on cruise ships to look at facilities, and sometimes they get a ride, sometimes they just get lunch or whatever. They are finding premises, negotiating with the landlord, installing the equipment necessary, the power. They're learning the franchise systems and hiring staff. What else? Everything. Okay. Dealing with the banking and stuff like that. So they're very busy. And I keep saying, have you reviewed the partnership agreement? Have you signed the partnership agreement? No, we're too busy. Reviewed the partnership, finally, no, too busy. And then they begin operating. Well, this is all new to them. So they're so busy operating that they go, no, we're too busy. We'll do it later. No, we're too busy. Do it later. They never got around to signing the partnership agreement. A little while later, if you know anything about cruises, one of the most popular cruises is a cruise from Vancouver to Alaska. Well, they used to go Vancouver to Alaska and back in 7 days. Okay, and then they got clever. Now they go Vancouver to Alaska as one trip. And then they go Alaska to Vancouver as a second trip, okay, because then they can make twice the money. Anyway, back when they used to go to Vancouver and Alaska, it took 7 days. And a Holland America ship is coming back towards Vancouver after this cruise, and it dings its propeller. So it's now going to have to stay in Vancouver for 2 days while they take off the old propeller and they put on a new one. If you have a 7-day cruise and you have to close down for 2 days, you have to give all the people their money back, okay, because you cannot give them a 7-day cruise, okay. So they're going to lose 7 days. And 2 of those obviously covered by the propeller being repaired, but then the other 5 days, the ship's just going to sit here idle, waiting for the next group, right? So my friend, client, goes down to Holland American and he says, I'll hire your ship. And they go, what? I'll hire your ship to go from Vancouver to Alaska and back, skip a couple of the ports, okay? And I'll make it a 5-day trip and I'll hire it. And they said, well, sure, because now they're getting income for the 5 days that they were going to be sitting idle. My friend client then goes to the Automobile Association, the BC Automobile Association, who were looking for something special to do for their 50th anniversary, or some big anniversary. And he goes to them and he says, how would you like to have your 50th anniversary general meeting on a cruise from Vancouver to Alaska, 5 days? And they went, whoa, that's perfect. So the ship, smaller than the ones now, has 1,200 rooms. He sells 900, just like that. Okay, so he has a few more to sell, and he's doing this after hours. Okay, and he comes walking into the office one day and he says, I'm in the money, I'm in the money. And his partner says, oh, what's going on? And he explains what he's done. And she goes, wow, how much are we going to make on this? And he goes, no. How much am I going to make? And she goes, no, we. And he says, hey, we've got a partnership agreement which says if we do any work after hours, we get to keep that money. It does not become partnership revenue. And she goes, yes, but we didn't sign the partnership agreement. And my friend client gets on the phone to me and he says, Peter, we have this agreement. Now, it seems to me I remember that verbal agreements are binding, okay? So we didn't get it in writing and sign it, but we do have this agreement, don't we? And I said, well, unfortunately, no. And he goes, why? And verbal agreements are generally binding, a little difficult to prove, but what happens here is the Partnership Act specifically says all partnership revenue must be divided equally between the partners. If you don't like this, you have to have a partnership agreement in writing, properly executed, and you can circumvent that section of the statute. So instead of making 100% of the profit, he only made 50% of the profit, right? How many times can you tell them sign the partnership agreement, and if they don't, they don't, right? Anyway, the bottom line is he made her sell the other 299 rooms. Wait, didn't I say there were 1,200, and he sold 900? So wouldn't there be 300 to sell? No, only 299, because my friend's lawyer got a suite, okay, and instead of getting paid for the legal work, okay, because I did the charter agreement to hire the ship, and of course, and I'm going to be right up front, I declared that money, the value of the trip, on my income tax. All right, you have to do that, otherwise you're in trouble. Anyway, he did not sign the partnership agreement, and that came back to haunt him in the end. Hold that thought when we get to shareholders agreement if you have a corporation. All right, so the fourth thing you can do, and I'm sure there are others, but these are the major ones, is you get insurance to protect your operation. Now, they have this cruise ship franchising business, not much in the way of potential liability, but somebody might walk in the door, slip, fall, injure themselves on some wet tile, and you get sued for occupier's liability because they would be an invitee and you must remove dangers of which you are not to be aware. Well, if you have insurance, public liability and property damage insurance, then that will be covered. Conversely, you could have a power outage and you could lose the power in the building for 3 days or something, and you lose that revenue. So that's a business interruption. Well, you want to have business interruption insurance. Chapter 9, we get into insurance for businesses. Okay. 2 sections of the Partnership Act of which you should be aware is Section 32 and Section 33, and they are on slide 171, but they're also in the partnership materials, which you are entitled to review during the exam. Section 32 says a partner must account to the firm for any benefit derived by the partner without the consent of the other partners from any transaction concerning the partnership or from any use by the partner of the partnership property, name, or business connection. I was teaching, when I was an associate with Mackay, DeWarr, and Turlock, I was teaching at Capilano University in the evening, 2 years. I got to keep the money. I became a partner in Capilano University. It was Capilano College then, but they said, do you want to do some more teaching? And I would have had to split the little bit of money that Capilano College would be paying me with my other 2 partners, okay? Because I'm a partner. I live, breathe, and eat. I'm a partner. I walk in and go, hi, I'm Peter Holden, a lawyer with Mackay, Turlock, and Holden. Bingo, I'm using the partnership name. I hand out my business card, hopefully to get business from the students, and I have to split that income. If a partner Section 33 says if a partner, without the consent of the other parties, carries on any business of the same nature, then he has to account for the income. And account means pay it over to the firm. All right, that is it for Chapter 7 on partnerships. And so this is just a very short chapter. And we'll get into corporations, which is used as a risk management tool to a great extent. And so we're going to spend considerably more time on that topic. But that's all for now.